Hey everyone, and welcome back to another Bitcoin and cryptocurrency video. In today's video we will be discussing the most up-to-date FOMC meeting. If you like this type of content, make sure you hit that like button, make sure you hit that subscribe button, as it always means a lot to me. And if you are a fan of cryptocurrency, I have a cryptocurrency shop where you can buy cryptocurrency products. I'll leave a link in the description down below so you can get a nice discount off your next purchase. So without a further ado, let's begin. We're going to talk about a few topics here. We're going to talk about the most up-to-date FOMC meeting, the results from that meeting, what I expect going forward with regards to the state of the economy, and how we can relate that to crypto. So, let's begin. And I just want to begin with the fact how the Fed essentially left the rates unchanged. Yeah. So going into this most recent FOMC meeting, which took place on the 1st of May, today is the 3rd of May, hence why the next FOMC meeting is in 39 days time. The next FOMC meeting is the 12th of June. But going into this FOMC meeting, I think everyone was essentially expecting the Feds to keep rates unchanged. Reason being is because inflation came in sticky and the unemployment rate was still at marginal levels. So with those two data points, it just made sense for the Fed to keep rates unchanged. But Jerome Powell did say something that did strike by surprise, and he mentioned that the Fed won't be afraid to essentially cut rates given that any specific action regarding the weakening of the labor market takes place. And what does that mean? He's essentially saying that if the unemployment rate starts to tick up with great speed, he won't be afraid to essentially cut rates. And just quickly, before the unemployment rate data came out today, the reason why I done this video today is because the unemployment rate came out today. So I wanted to do the unemployment rate data as well as the FOMC meeting in one video instead of just doing two separate videos, because I'll probably be saying the same thing when it comes to relating to the price of cryptocurrency and how it will affect the asset class. But with regards to the unemployment rate, today the data came in relatively sticky. Yeah. Today, the unemployment rate came in at 3.9%, hotter than expected. The Fed predicted that the unemployment rate will be 3.8%, but the data came in at 3.9%. Still 1/10 below that 4%, which is where I believe the Fed will look to start to pivot and then cut rates. But it was very hawkish because last month the data came in at 3.8. They were expecting that it would remain at 3.8, but it went up to 3.9. A 0.1% increase month over month. Again, as I mentioned, it did not hit that 4%, which is why I think the Fed didn't pivot last meeting. But I'm of the opinion that the Fed will essentially cut rates next month, and I'm going to go into that as to why. But it's quite funny because before this 3.9% print came in, the market makers were suggesting that the first rate cut won't happen until September, November. But as soon as this 3.9% unemployment rate print come in, that is when the market makers then said, okay, it's likely that the first rate cut will happen in September. I'm of the opinion that come FOMC meeting mid-June, that we will get our first rate cut. And there's two reasons as to why. The first reason is because it is not about how high interest rates are. It is about how long you have essentially trended within that percentage point. The reason why I'm suggesting that we will get no more rate hikes despite inflation, despite the unemployment rate still being below 4%, is because we've spent a large amount of time around the 4 to 5% region. It is not about how high interest rates are. If interest rates went to 5.75%, that wouldn't make sense. Because we've been in this region for such a long time now. What is a 5.75% interest rate going to do? Nothing. Legit, nothing. It doesn't make sense for the Fed to do that. Unless something drastically happened where inflation started to really soar again and the unemployment rate went back down to 1%, which is highly, highly unlikely. The reason why the Fed isn't going to increase interest rates is because before we found out the unemployment rate was 3.9%, we had already spent many, many, many months in this territory right here. And it's about how long you spend within this territory rather than how high the interest rates is that does the damage to the economy. To put it simply, if you're just 1 month at 6% interest rates, and then the next month you're back down to 1%. So let's say you're at 7.5% for 1 month, yeah? And then the next month you come back down to 1% interest rates. This 7% interest rate isn't going to do nothing to the economy because it's just going to come straight back down. It doesn't impact the economy. What impacts the economy is when interest rates are higher for longer for a significant amount of time. As previously mentioned in my FOMC videos, it is essentially how the market doesn't feel the effect of rate hikes until 12 to 18 months later. And this is what I believe is happening, and this is one of the reasons as to why I believe the Fed won't rate hike anymore. The second reason why I believe the Fed won't rate hike anymore, instead rate cut next meeting, is because of this unemployment rate print. Now, coming in at 3.9%, that is not what participants should want to see, because when it comes to the unemployment rate, when this thing starts to move, it starts to move. You can see in prior history that once the unemployment rate bottoms out and then comes into some sort of a bottoming range and then balances out, once it gets going into that uptrend, boy, it is a train and it does not stop. Same again here. Once it forms that bottoming formation, gets an uptrend, it just doesn't stop. It just sets off like wildfire. Again, back here, and all of these guys, they transcended from recessions. Like, we had a recession in the early 90s, we had a recession in the dot-com crash, which was the late 90s, early 2000s. We had another recession in the late 2000s, the global financial crisis, and we also had another recession in 2020 due to the pandemic. You can see that each time looks exactly the same, where the unemployment rate sort of has this bottoming out formation, goes into a small uptrend, and then just blasts off, and nothing just stops it. The same again is happening this time, so why should we believe any different? Where the unemployment rate essentially bottoms out, goes into a small uptrend, and then all of a sudden explodes. The reason why it is looking like it's taken longer than usual, because before you can see that these bottoming formations only lasted a few months, whereas this time it's actually lasted a whole year or so of just the unemployment rate going sideways. And that is because of all the liquidity in the system that's been left over in the system from the COVID money printing. The COVID money printing, the reason why we got out of that recession so quick is because the Fed turned the money printer on significantly to the point where so many people had so much cash. That is why inflation went to the moon. But because there was so much cash in the system, it obviously takes a long time for that money to get drained from the system, which is also why the unemployment rate is taking its time to go into sort of this uptrend. But man, when this unemployment rate starts to move, it's going to start to move. And that's why I believe that a print of 4% plus is what will force the Fed to pivot. The inflation data has not come in yet. I'm going to make another video when the inflation data comes in. We're going to have to wait a week or so for that. But that's currently at 3.5%. Now, if inflation data prints lower than 3.5%, which is what it was last month, then it's likely the Fed will pivot if the unemployment rate hits 4% before we get that next FOMC meeting, which is the 12th of June. So if we get that positive inflation print where it's below 3.5%, and then we get an unemployment print that is 4%, the Fed is 100% cutting rates. And again, as I mentioned in the point earlier, it's not about how much interest rates are, it's about how long you spend within that threshold. Coming back down to 5.25% isn't really quantitative easing. It's still quantitative tightening, but just at a slower rate. So the Fed cutting isn't doing much of a deal. Just as much as going up to 5.75 isn't much of a deal. They'd rather just leave it unchanged. But going to 5.25 isn't much of a deal. Hence why I firmly believe that they will cut rates. There's a difference. It's not quantitative easing. Quantitative easing is these periods here when interest rates are flat for such a long time. Coming back down to 5.25% isn't quantitative easing. It's still quantitative tightening, but just at a slower rate. There's a difference, and a big difference there. Another reason as to why I believe the rates won't hike and they'll look likely to cut soon is because of this statistic right here. So this chart essentially shows the length of time from last rate hike to first rate cut. The terminal rate, it is known as, where we reach a peak equilibrium right here, and it essentially analyzes how many months it takes from the last rate hike to the first rate cut. On average, the Fed takes around 8 months from the terminal rate until the first rate cut. It's around 8 months. This time around, we are at 10. So we are 2 months above average, where the Fed keeps the rates at the terminal rate. Now, there's only a few times in past history, in the global financial crisis, the dot-com crash, and in the late 60s, early 70s, where the Fed kept the terminal rate at these significant highs. Whereas all other times have been around 4, 5, 6, and 7. We're currently at 10, which is well above average. So we could expect some sort of a reversal soon. I mean, it's not going to take many more months to get some sort of a resolution before the first rate cut. Yeah. So what to look forward to? I mean, again, as previously mentioned, if the unemployment rate prints 4% before the next FOMC meeting, and if inflation rate comes below 3.5%, the Fed is 100% cutting rates to 5.25%. That is my opinion, but I believe that is what is likely going to happen. Now, how does this impact Bitcoin and cryptocurrency? Well, it's quite simple. When discussing monetary policy and you're trying to compare it to risk on asset like Bitcoin and crypto, it is all about liquidity. Risk on assets is all about liquidity. And if liquidity is getting drained from the system, you have to believe that the markets will keep climbing the wall of worry until something within the economy breaks, first of all. Second of all, you have to believe that the higher risk assets will bleed into the lower risk assets. So altcoins that are, their market cap's in the 1,500th, they will bleed to Bitcoin over the long run. By long run, I mean over this rate hiking cycle, which is this right here. So that's two things. One, rate cuts aren't bullish. They're actually bearish for stocks and cryptocurrencies. And two, high risk assets will bleed into lower risk assets. That is exactly what it means for crypto. And you can essentially compare this with the Bitcoin dominance and see why I say that. Because as we go into a rate hiking cycle, like so, the Bitcoin dominance goes into an uptrend. When quantitative easing returns, that is when the Bitcoin dominance goes into a downtrend. Again, the Bitcoin dominance has been an uptrend due to quantitative tightening. And then once we get quantitative easing, the Bitcoin dominance will then drop. So that is how I believe it will impact crypto. We just have to wait for that first rate cut. That first rate cut will then spook market participants, and it's not what you mean. It is not quantitative easing. It's still quantitative tightening, which is why I believe that cryptocurrencies against their US dollar pairs will go down. But as we are higher for longer, altcoins against their Bitcoin pairs will bleed. So that is it from me today, guys. I hope you all enjoyed the video. If you did, smash that thumbs up, smash that subscribe button, and as always, it's been your boy J1 General. Thank you and goodbye.